And these inverted markets rarely happen, but they're very exciting when they do, especially when they cross over. We'll talk about that in a second. Let's look at a chart of the light crude oil. Here we have an example of backwardation in a chart format. I chose candlestick charts. I like to use them. I know Pristine is a very strong proponent of candlestick charting. And when you look at this chart, you see that the near-term month, this entire time from November till now, has been very aggressive. And in fact, in a lot of places, way far and above the further out month in the green month, which is May. And we look at this and we can immediately see that backwardation is a very unique scenario, especially if normal markets operate where the further out month factor is higher than the near months, factoring in all the costs. So there's a strong demand, and this is a very bullish indicator if you get in on the right time. This time it's a little bit late. You would trade it, and you can trade it, but it'd be better to see when these things change. This is how we speculate on the price in looking at inverted markets and looking at backwardation. One of the primary ways is when we buy on switchovers from a contango or normal market to a backwardation market. This is a very, very bullish event. When you see the price jump in the near-term months and start to exceed the further out months, that means demand is very strong, or there's a supply shortage that you don't know about, and that you've got to jump on the train to take advantage of it. I mean, it's just an amazing event, especially if it's not a normal occurrence. So always watch the prices, look through the newspaper, and when you end up, or look through online at different pricing quotes. When you find an opportunity to invest in a contango to a backwardation market or an inverted market, definitely review and see how far long it is into the backwardation cycle, and look to definitely take advantage of it because it's a very bullish indicator. On the other side, there's great opportunities to sell on switchovers from backwardation to a contango market. And this ties back in with what I explained about the futures and the cash converging. Oftentimes in backwardation markets, the price starts to drive downward as it gets closer towards the end of that contract's life cycle. So there'll be opportunities for you to trade and see backwardation markets switch over because maybe the supply is not needed as much in the following month or in the following expiring contract. And so there's opportunities to trade there. You can also combine these price anomalies of inverted markets and normal markets with their notice days and see what typically should happen with the hedgers and what isn't happening and trade the difference. Contango and backwardation always reflects supply and demand. And so even if you don't trade them for the near month or the following month, it's good to get an idea of what the potential prices of oil or gold are going to be 3, 4, 5, 6 months from now. And as we saw, the further out months on oil just didn't matter. Nobody was concerned that the price is going up, so maybe there's more than enough supply in the furthest out month of June. And so that kind of gives you an idea of even what the real world prices are going to look like. So maybe going into the summer, we may have an easing of the oil prices from the $2 that we're paying now in gas out here in California. Demand or lack of demand takes precedence over expiration date. So the price matches what the hedgers need. So even though we talked about how the first notice day and the last notice day and how the last trading days work, always keep in mind that since the markets are driven by supply and demand and the hedgers take precedence, what happens in price is more important than following any hard and fast rules. Keep in mind that you want to be dictated of your actions through what happens with the market, not with any hard and fast rules. So understand when the markets are inverted, understand when they're in a normal phase, and trade according to what the market dictates. You don't trade to any hard and fast rules you may learn here. You'll learn from your own experiences how you should be trading based on your volatility and your risk and reward thresholds. Now we'll go into some of the reports that hedgers use. At one time, the whole entire nation was wired with telegraphs. And the funny thing about the telegraph is that most telegraphs were wired and transfer it immediately back to the exchanges and futures. There's these old photographs of the Chicago Board of Trade and one of the earliest futures exchanges where you see lines and lines of telegraph wire just pouring into this building from all over the nation, where every train terminal was going to deliver corn or wheat, where every silo was dictating prices. And so for a long time, the exchanges really held a monopoly on the information. And I personally believe, and to this day, the exchanges have a strong source of information for you to understand how these contracts are working and how they operate, especially since many of these contracts are proprietary to every exchange. Each exchange has its own types of contracts and their own expiration dates and their own style of doing things. And then the second source is government. Futures are regulated literally from the top down. We have the Commodity Futures Trading Commission, which is a governmental agency that licenses myself and other futures professionals and makes sure that we're doing what we're supposed to be doing. And then there's a second body, which is the NFA, who we're associated with. And then there's no one else. We don't report to the states like stockbrokers, and we don't have to be licensed separately by the states. So the government has majority of the information necessary for you to look at what the hedgers are doing. And we'll talk about that. And then lastly, news is a source of information. News is great for last-minute blurt-outs, like, for instance, we had the mad cow disease occur, or when China ended up having a soybean shortage. News is great. But usually when it shows up in the news, and this is definitely a fact for futures, the prices have either already been factored in, or the people in the know, the hedgers, have already taken advantage of it. And I have a few charts where I'll show you how this occurs. Let's look at some of the informational sources. There are about 4 top exchanges, and there's also the One Chicago, which deals with single stock futures only. You have the Chicago Board of Trade, which is CBOT.com. You have the Chicago Mercantile Exchange, which is CME.com. The New York Board of Trade, which is NYBOT.com. And then you have the New York Mercantile Exchange, which is the NYMEX.com. All of these exchanges have all the necessary information that you need on how the cash market is trading, how the futures market is trading, and some of them even now do direct feed from their online base, where they'll give you the information of what the prices are, how to make your charts, and you can pay them directly if you just want to trade the CME or the NYBOT or the Chicago Board of Trade. So you have choices. The important point is everything that you need to know about a contract is there. They invented the contract, and so they have all kind of white papers on what hedgers should do. They have all kind of white papers on what the euro dollar is and what swaps is. And now that derivatives are getting more and more sophisticated in how they're operating, the information is there for you. So they're a great informational resource. They also have just innocuous information that people wouldn't even think is important, but for us as future speculators to find out where things are being exported and who's exporting it and who's importing it are very important in determining what the supply and demand factors are and how hedgers are going to react. One thing that people always say is that the markets always react opposite to what you would think is common sense. Well, yes and no. The reason why they act opposite of what you would think is common sense is because as speculators, we aren't putting ourselves in the other person's shoes. And if the market is designed for hedgers, we need to put ourselves in the hedger's shoes in order to see how they view the market, and then we'll see how the market is supposed to be making sense. A lot of educational information on these websites. They have getting started material. I mean, just a fountain of information. If you go to any one of these websites, you can spend hours just absorbing so much information. I believe the NYBOT even has online audio clips of seminars that they've done in the past. I listened to several of them. They're great, because like yourself, I'm always going to be a student of the markets, and wherever I can get more information is going to definitely help me. So great source. The frequency of reports varies, and you have to go to each exchange to find out. I know the New York Board of Trade once a week actually sends me out a detailed analysis of sugar, cocoa, coffee, what's known as orange juice, all of which are known as SOFs, and so they send out the SOF report.